All right, we're almost done. So we know our letters, we know how to make words out of them, to make sentences, and now we're going to come up with paragraphs. We're going to talk about the financial statements, the whole point really of everything you've done so far. There are a few basic steps. When you get more complicated, there's a few extra we'll throw in. But the basic steps are to journalize, and that's what you've done already. The journal entries, if you think about it, are in transaction order, which is going to be date order, just like your diary is a journal that's in date order, so is the general journal. Next, you post the journal entries to the general ledger, and post just means copy. You're going to copy the amounts in the journal to the ledger, and the ledger is different because it's in account order. It's nice to know what your transactions are, but you need to know what your cash is at any point in time, for example. From the general ledger, you're going to copy those numbers from the general ledger to the income statement, which will tell you how profitable you are, and then to the balance sheet to figure out that your assets equal your liabilities plus stockholders' equity. So the general ledger looks something like this. It's by account. And so by looking at the last number, you can figure out what the balance in your cash account is at any point in time. We usually post at least once a month. With computers, you can do this daily or even more quickly than that. But at least once a month, you post from your journal to your ledger. The only thing special here is that reference, and that's how we can trace an entry in the ledger to our original journal entry. So for example, J1 is entry J1, and that means it's in your general journal, page 1. Normally these are page numbers. Here we're going to do it entry by entry. By looking at the general ledger, you should be able to determine what the journal entries must have been. So if you want to pause this for a little bit and jot those down, that would be fine. Otherwise, we're going to run through them very quickly. So if you follow the J1s, notice we debited cash, we credited common stock. So we must have sold some stock. J2, there's a debit to equipment and a credit to cash. So we bought some equipment for cash. J3, gas expense and cash for $400. So we used up some gas to mow somebody's lawn. And then in that fourth one, we collected the cash for that lawn that we mowed. So we have revenue. Obviously, those journal entries are done first, and then we take those numbers and copy those to the general ledger. Our debits and credits have to equal in the journals, and if we post everything correctly, our general ledger debits and credits have to equal as well. So this is where it's important, again, for you to remember what you do to increase an account, because that means cash should normally have a debit balance. Hopefully we're always increasing it. Common stock always has a credit balance, as well as revenue having credit and gas expense having a debit balance. So we take all the numbers from the general ledger and we, again, just copy those into an income statement format and a balance sheet format. The income statement tells us how profitable we are, and the balance sheet just verifies that initial accounting equation. The relationship between the two then is the net income. If you remember, retained earnings is all the earnings, all the profits we've had by the company over the course of its lifetime. And so the net income is part of the retained earnings. And so you always have to start with the income statement, and then we're going to take the net income from the income statement, add it to retained earnings, which is part of stockholders' equity. And if you don't do it in that order, your balance sheet won't balance. So the retained earnings formula, you probably could just figure out, but the beginning retained earnings plus your net income. We've already talked about how dividends subtract out of retained earnings, and that is a separate general ledger account, and that's where you get the ending balance and retained earnings. So to show you how this all fits together, on the left, that's just the portion of the ledger that you saw before. And we only had a few accounts. So I'm going to take that ledger and start with revenue. That goes in the income statement. Subtract out my expenses. Here all I've got is gas, so I'm going to subtract that one out. That's all I've got on my income statement, so I have net income of $1,600. I then move to my balance sheet. Cash is $93,600. Equipment is $8,000, so my total assets are $101,600. I don't have any liabilities in this case, so I've got a spot for it, but I don't have it. Common stock then is $100,000, so that goes in there under stockholders' equity. So the last thing you have to remember is take that net income, add that to your beginning retained earnings to get $1,600 as our ending retained earnings. Here we don't have any beginning balance or dividends. So our total liabilities plus stockholders' equity is $101,600. That equals our total assets. If you do it right, those two things always have to balance. Notice we have double rules underneath things. We two underlines, and in accounting that means stick a fork in me, I'm done. When we say we double rule something, you're done. Everything balances, you can move on. So our income statement and balance sheet should look like this. You can put the liabilities underneath the assets and the stockholders' equity all in one column if that's easier for you to fit on a piece of paper. But kind of the normal format is, again, assets on the left, liabilities and stockholders' equity on the right. So a more complicated example, let's look at the income statement. First of all, notice your income statements for a period of time. You have to decide what day you're going to start counting, what day you're going to stop counting. Because again, I might do a job on January 1st of the next year. I need to know where I'm going to put that. The revenues minus cost of goods sold. I've got one new account here that we haven't talked about, and it's not an account, it's just a subtotal. And that's your gross profit. Sometimes you call it gross margin. If you ever watch Shark Tank, they'll always ask, what's your margins? They'll ask, you know, what are you selling this for? Let's say you're doing a new vacuum sweeper. We sell it for $100. They'll ask what the cost is. The cost is $40, and so you got $60 left over to cover all your other expenses, and that's your profit or your gross profit or your gross margin. So if we are selling merchandise, we usually have gross profit. If you're mowing lawns or doing services, doing plumbing services, we often don't have a gross profit subtotal. Notice here our net income is $22,000. So when I go to the balance sheet, notice the net income that I added to retained earnings is $22,000. Besides that, just list all your assets, list all your liabilities, list all your stockholders' equity, and cross your fingers and pray that everything balances. And here they do. So almost done. See if you can put some of this together and come up with some financial statements. Good luck.